Welcome back, friends. We are going ahead with the discussion on brand valuation in this session. If you remember, last session I was mentioning about valuation approaches, and we were talking about holistic methods. We talked about comparison as well. Now I will be giving you a brief insight on how practically larger organizations which are known for this kind of business, should I say, which are known for actually using these methodologies for their clients, how they broadly do it actually. I would not be going into the finest of the details on how they do, but definitely this will give you a very apt idea of how these organizations they do that, how actually brand valuation is done. And when a couple of sessions back I was talking about Tata's, when I mentioned that it is somewhere $22 billion or 21 point something billion dollars. So one of these organizations or any other organization for that matter would have reached to this number somehow. And we have talked about approaches involved there. So we talked about cost based approach also and income based approach also, and several approaches are there. Let's see which of these organizations tend to use what kinds of approaches in totality, and how they proceed and put up value in terms of particular brands. Now largely I am focusing upon only three, and the list is not limited to these three, but these are known, and the source which I have used for this strategic marketing management, by Chernev A. So that source talks about broadly these three organizations, and these are well known brands by themselves also. And then I talked about rating and ranking agencies. These are valuation agencies or valuation organizations, and then they have developed these methodologies in due course of time. They have huge data, they have huge database, they have set methodological frameworks, they have experts involved with them as their employees, as their team members, who keep on focusing on valuation of brands. So Interbrand, Brand Z, brands you may call it anyways, and Brand Finance. And then let's look at their framework at large, broader framework which they utilize. So and then for details you can refer to the source I have mentioned already. So Interbrand focuses on financial performance, the economic profit. So and it's a whole lot of a methodology which definitely has a cue from all the methodologies we have talked about in our earlier discussions. So they utilize those kind of frameworks, and then they think in terms of or analyze financial performance or economic profit of an organization or a brand at large. Then role of brand in purchase decisions, and that is related to brand index. So how brand actually affects the purchase decisions of the customers may also influence the decisions of the prospective customers. Then they focus upon brand loyalty strength, and here the focus areas are clarity, commitment, protection, responsiveness, authenticity, relevance, differentiation, consistency, presence and understanding. But we have heard about these terms, we have been talking about these terms, and they are focusing on these terms to be deciphered as in terms of a value actually. And then we have talked at length about consistency, for example. So they try to put up a weight around these terms actually. These are all qualitative aspects, but then you have to put a number around them, and that number must be in terms of money value. Then comes in brands, brand Z. So, brand earnings, that is earnings attributed to a brand. This may resonate with role of brand in purchase decisions, but somehow it is related to what a brand earns for you. So might be the orientation might be slightly similar, but again the pathway kind of is or let us say there might be some difference between the methodologies they would be applying, although ultimately you have to talk to the customers. Then financial value, predicted future earnings, that is potential of a brand, what it will bring actually, because if you try to understand this, then only you would be able to focus upon what kind of marketing program investment you should be making. Then and your stockholders would definitely be worried on what kind of future potential this organization gains, because your future prospect in terms of your revenue generation would affect the stocks as well, the dividends. So then they focus upon brand uniqueness, and here it is related to the brand's ability to stand out, known amongst known, that is the concentration basically. You see many a times when you look at several luxury cars parked with each other, and one of those may gain slightly more attention from your side, that is what we are referring to here. So if you go to a large automotive retailer, there are multi-brand retailers in many parts of the world. So if you stand in those large showrooms and you have several beautiful cars rotating on the platforms all around you, and one of the cars actually makes you stop and you want to take a picture along with that, that is what we are talking of. Calculated value, wherein a formula for calculating the three factors above to yield a single value, and that is where they focus upon. There are several kinds of combinations which can be generated. They definitely have a specific kind of a formula with them, or they might be working upon revisiting the strength of the formula time and again, depending upon what kind of variables they evolve as the stronger ones in due course of time. That definitely depends upon how they pursue that. Now brand finance. So brand finance actually they are thinking in terms of enterprise value and then the brand contribution, the overall uplift from the brands, how brand is contributing as far as the complete organizational growth goes. And then the third element which they focus upon is related to brand value, the value of trademark and associated intellectual property as well, which is again a very important thing, because you want to understand that what your IP holds in terms of value as far as the whole scenario goes, and your IP definitely supports your brand strength, because you have done something special which you are known for. So that is again another way of looking at things. And we talked about briefly about income approach, market approach, cost approach. Now let us decipher those with reference to, let us say, what different organizations might be doing. So here this elaboration would actually yield for us a broader picture of all these approaches, because when we look at these organizations and their framework, somewhere the reflection of these approaches that comes into play. For example, when you say enterprise value, then one of these approaches definitely would be apt for us to take us there towards that understanding. So income approach talks about present value of the future earnings, that it is expected to generate over its remaining useful economic life. And this is one of the most used approach basically. You anticipate the returns or the income a brand would bring for you. Here I would would like to remind you of that at this moment you are also looking at your marketing program. You are actually thinking in terms of the product life cycle in consonance with the brand life cycle. Product life cycle is a more defined kind of a concept, wherein brand life cycle is an evolving concept, and there are so many aspects to it which are being brought by several organizations and several thinkers, but still you are looking at your brand somewhere in terms of a pathway. So, that actually resonates, because that is going to guide you in terms of what kind of income your brand would be generating in future. Now, considerations are current cash flows, forecast growth, the risk associated with future earnings, and here the competitive perspective, the environmental forces, the changing technology, everything comes in. And that reminds me of one or two examples, like for example Kodak and Fuji, because photography world, cameras, the methodology through which we photograph has changed dramatically in due course of time. And probably at one part of time when these brands would have been evaluated, they definitely would have been thinking in terms of when they would be utilizing, for example, income approach, they would be thinking in terms of risk associated probably. Although brand valuation of these organizations was quite suitably respectable or high at one part of time, but again I would not go into how where did it reach and what happened, but the point is I am just trying to draw your attention towards the risk associated in terms of competition and technology, technological changes in coming times. If you look at this perspective at Titan watches, for example, definitely they also would have the similar kind of consideration in mind when the valuation perspective. Today if someone is valuating Titan as a brand, definitely this changing technology or preferences of consumers, or the risk associated in terms of why would people keep on wearing watches and what kind of marketing program strength they would have, that kind of a question would definitely come to their mind. So, then again the brand's useful economic life and tax considerations also are there. The methods applied here are related to price and volume premium methods, income split method, multi-period excess earnings method, and I am just enumerating those. These are specific methodologies which consider giving specific weights in terms of value to the precise, either the potential or the marketing program or activities. So and then to reach to a number that this would be the value. So, and then there is an incremental cash flow method and royalty relief method, and these approaches can be utilized independently and in association as well. You can utilize one approach and then you can corroborate one approach with the other approach as well, if you want to strengthen your belief that this should be the value in terms of a particular kind of a brand. So, market approach says that it is related to value in comparison with transactions for similar brands. Here you have a particular kind of a comparison, mostly used during selling of a brand. So, when it is exchanged, the hands are changing, because you have to offer, for example, an organization is offering itself for sales. So, what kind of premium they may charge on the name precisely. Asset valuation can be easily done, but looking at, and remember when I talked about brand equity earlier, I mentioned this word that brand can be looked upon with the perspective of being an asset. So it's it can be seen with the accounting perspective, wherein this asset value can be put up to the brand's name. And then one organization is looking for for example, Walmart took over Flipkart, so definitely some valuation would have been done, and there would have been a particular kind of a methodology. So there you utilize, and the considerations are the markets in which the brand operates, relative brand strength, legal protection, and economic outlook at the times of transactions. Probably in Flipkart's case, their subscribers base would have been seen, probably how strongly their customers, they believe in them, how well the program of pay at the time of delivery would have worked for them. That was a unique program which was initiated by them. So you see, there are several considerations. I am not sure what kind of actual balance sheets they would have been suggestive of at the time of this takeover, but the point is that they were valued, and that too at a good price and a good premium. Now the methods are brand sale comparison method, equity evaluation method, and residual method. Now the third widely used method is cost approach, which is again a very apt approach. It's slightly from this side, and it is related to value of a brand based on the cost invested in building the brand. What kind of investment we have made in as far as the brand development goes, because you see, the point is that investment is going to yield for the organization which takes over the brand at the later stages, or you would like to put up a premium in terms of the cost which you have already incurred in developing that brand on the products you want to sell in future. So and then that is where cost invested in building the brand or its replacement or reproduction cost, vanishing it off, putting something new, wherein many a times you have to take crucial decisions of changing the name, repositioning, revitalizing. I will be talking about all these things in later discussions, but these are the aspects wherein you want to focus upon, because you have to take a call in terms of going in for future in revitalizing something. For example, Enfield would have done this somehow. So they would have focused upon the kind of investments they would have made in terms of developing that brand, and they would have immediately realized that this is the kind of potential. So they would have gone for, probably, I mean, it's just a wild thought, wild thought that they would have thought of cost approach as well as market approach as well as income approach in terms of potential, for example. So that is why somehow we realize that at the end of the day, Enfield has a particular kind of a price option. Then they went for a specific marketing program, opening up retail shops, and then interiorly decorating. The interior decorations of Enfield retail showrooms are different as compared to they would have been a decade back or 2 decades back, and now it's a very different kind of an outlook. So all those things would have been done on the basis of research as well as valuation and methods. For example, this method, although is used most in terms of investor perspective, but not limited to that, and considerations are marketing costs, awareness among customers, market share, probability of success for similar brand launch, and similar brand launch is one of the key words, and methods are accumulated cost or historical cost method, replacement cost method, conversion method, and customer preference model. Customer preference again is an important aspect. Now let us quickly expand what we are discussing. So, let us start from income approach. Price premium method estimates the value of a brand by the price premium it generates when compared to a similar but unbranded product or service. And remember, I mentioned that what kind of energy should we be actually spending on the branding exercise for brand, and this is a genuine question which would come from the leadership of the organization. Why you want to put in that kind of a marketing effort? Are you going to charge a premium on this, or customer expansion is on the way? So, that is a very genuine question before the organizational leadership supports the brand manager to actually put up a marketing program. Now, this must take into account the volume premium method as such, and volume premium method estimates the value of a brand by volume premium it generates when compared to a similar but unbranded product or service. This must take into account the price premium method also. Now, the whole of the situation is quite sequentially associated with each other, and then there is income split method. This values the brand as the present value portion of the economic profit. Just take it as 1 plus 1 kind of thing, basically sequentially. So, the present value portion of the economic profit attributable to the brand over the rest of the useful life. So, how the present value would support the future useful life. This has problems in that profits can sometimes be negative, sales is not doing well, it is a dip kind of, and it may lead to unrealistic brand value at that particular time, or if you consider that time frame, and also that profits can be somehow worked upon for a piecemeal basis, and then so may because if you exert on enhancing the profits, you would go for a specific marketing program, and profit for that period might enhance, and that may also represent brand value at a later stage, because you will be actually going for a periodical analysis. This method uses qualitative measures to decide the portion of economic profits to be accredited to the brand. The point here is that somehow if we slowly reduce the marketing program investment, especially communications or other related kind of expenditures, would it go by itself? Now, that is the point of concentration, because you want to take a call that either you want to determine that you can maintain the price of the product and reduce the cost on the side and gain profits, or you want to redirect your resources for some other product with a similar kind of a brand name. You want to project it that way. So, you have limited resources. These are all strategic decisions, and that is why I suggest you to remember when we talked about brand architecture strategies. So, there we were thinking in terms of architecture and strategic perspective. Now, there is a multi-period excess earnings method as well. Now, this method requires a valuation of each group of intangible assets to calculate the cost of capital of each. Simple. The returns for each of these are deducted from the present value of the future cash flows, and when all other assets have been accounted for, the remaining is used for the value of the brand. It is a very simple kind of a thing. It is a deductive kind of analysis, but again the point is that you have to look into the periodical aspect also. You have to look into several other elements which contribute in brand development, and definitely the asset valuation has to be done. Incremental cash flow method or excess margin identifies the extra cash flow in a branded business when compared to an unbranded and comparable business. However, it is rare to find conditions for this method to be used, since finding similar unbranded companies can be difficult. But many a times, when there are organizations which have been working in the business of commodities, or let us say business to business only, and they are thinking in terms of generating a business to consumer, business to customer outlook, and they are dissociating themselves from the lot actually. So, there it would definitely become important. Royalty relief method, it assumes theoretically a company does not own the brand, it operates under, but instead licenses the use for another. And the royalty relief method uses available data of similar arrangements in the industry and assigns the value of the brand as the present value of future royalty payments. Again, some hypothesis is utilized here, some valuation perspective is utilized here, some present value is utilized here, and some future value is utilized, and then asset aspect is also there to accompany that. But again, the point is that we want to judge what is going to be the number associated with us in terms of this name, this logo, this symbol actually. For example, Nike decides that today, Patanjali decides that today, Tata we all know, Infosys decides today, and then we have statistics on this. You can visit some credible statistical sources, and you can think in terms of finding out what brand valuation has been done for them, and then you can always think in terms of going backwards while reading literature on either imagining or if clues are given there that what kind of methodologies they have chosen. Now, in terms of market approach, brand sale comparison method is there. Now, this approach entails the valuation of the brand by observing current transactions concerning similar brands in a similar industry and referring to similar multiples. Again, a different kind of a perspective, simple. In other words, this approach takes the premium that has been paid for similar brands and applies to the brands that the company owns. So, can it be with me as well? Now, the benefit of this method is that it appears at a third party angle, that is what the third party is willing to pay, and is easy, and then it's easy to calculate as well. However, the flaw in this approach is that the information for similar brands is rare, and the price paid for the same brand consists of the synergies and the specific goals of the buyers, and it may not be relevant to the value of the brand at issue. As you would have noticed that none of the approaches are complete or composite by themselves. They can be utilized for specific purposes, and that too by experts who have that kind of an efficiency for going for that kind of a data, finding out those details, and then have that acumen of actually analyzing and calculating based upon that kind of an information and data. So, but again, and then there are several kinds of flaws with almost every approach, but the purpose is same, the objective is same, and to reduce the flaws we can use multiple approaches and then corroborate the results with each other. Brand equity based on equity evaluation method may be it can also be seen with the reference to market approach. Now, brand equity may be divided into components: the demand enhancing component, which incorporates advertising and results in rate premium profits; the cost benefit component, which is acquired due to the brand during new product introductions and through economies of scale and distribution. Hence, they essentially anticipate the price of brand equity using the financial market value, and the benefit of this method is that it is based on empirical proof. However, shortfalls of this methods this method are that it assumes a very sturdy state of efficient marketplace hypothesis, and that all information is covered in the share price. Then there is residual method, and Keller has proposed the valuation of the brand by residual value, which might be when the marketplace capitalization is subtracted from the net asset value. So again, and we have talked about residual approach earlier as well. This approach is beneficial in calculating the potential value of line extensions. However, the inherent assumptions in this method make any practical application hard. But again, there are pros and cons and profits, benefits and flaws to every kind of an approach, but everything has to be seen cumulatively. And cost approach I have talked about, wherein accumulated cost or historical cost method is there. I mentioned about this, and it is often used at the initial stages of the brand creation when specific market application and benefit cannot yet be identified. You see, it actually aggregates all the historical marketing costs as the value. Then there is replacement cost method, which values the brand considering the expenditures and investments necessary to replace the brand with a new one that has an equivalent utility to the company. Acker has proposed that the cost of launching a new brand is divided by its probability of success. So there are conversion models and customer preference models. Conversion model is associated with that wherein one estimates the amount of awareness that needs to be generated in order to achieve the current level of sales. This approach would be based on taking the level of awareness that induces trial, that further induces regular repurchase actually. So what would take the customer forward, and how customer would actually keep on purchasing the product? Are we thinking in terms of analyzing why a customer would become loyal at the end of the day? Probably yes. And then last part of, as far as my discussion goes, customer preference model. Customer is the king at the end of the day. Acker in 1991 proposed that the value of the brand can be calculated by observing the increase in awareness and comparing it to the corresponding increase in the market share. A very simple analysis and a wonderful one. Awareness gets generated and market share gets enhanced. Are we focusing upon integrated marketing communication as a major part of the marketing program at this moment? And if we are, then you must visit integrated marketing communication course, which I recorded earlier, wherein there is one flaw with this model. It assumes a linear function between awareness and market share. So as I said, flaws are there, but let's look at the advantages of these models and let's utilize these models cumulatively to our advantage as the students of brand management as well as future brand managers. I will be coming back to you. Till then, keep studying. Goodbye.